The legacy stocks in your dividend portfolio are not dying. They are being reclassified quietly, without announcement, without the kind of headline that would prompt you to reconsider your position. From businesses competing on the same terms, they have always competed onto businesses that are either using automation to structurally lower their cost base and expand their dividend capacity, or businesses that are watching their competitive position erode to operators who are. The difference between those two categories is not visible in the current dividend payment. It is not visible in the trailing payout ratio. It is visible in the free cash flow trajectory over the next 6 to 8 quarters. And by the time the trajectory becomes undeniable, the share price will have already moved to reflect it. The investors positioned in the right category before that movement will benefit from it. The investors in the wrong category will be reading a press release. Let me establish what the AI automation pivot actually means for legacy dividend-paying businesses. Because the financial media coverage of AI has been almost exclusively focused on the companies building the technology and almost entirely silent about the specific measurable impact that deploying the technology is having on the cost structures and free cash flow generation of the mature income-producing businesses that most dividend investors actually own. When a legacy industrial company automates a manufacturing line that previously required 40 workers and now requires 4, the labor cost reduction does not disappear into the business as a general efficiency gain that management allocates at their discretion. It flows directly into operating margin, from operating margin into earnings, from earnings into the free cash flow coverage ratio that determines whether the dividend grows, holds, or faces pressure. The automation investment pays for itself in the cost reduction it generates, and once it has paid for itself, the ongoing cost savings are permanent additions to the free cash flow available to fund shareholder returns. The dividend growth rate of a business that has successfully automated a material portion of its cost structure is not the same dividend growth rate as the same business operating at its pre-automation cost base. The math is fundamentally different, and the income investor who has not recalculated it against the new cost structure is holding a position whose forward income potential they are significantly underestimating. The 3 legacy categories where this pivot is producing the most measurable and most investor-relevant impact in 2026 are mature industrial manufacturers, established financial service operators, and legacy telecommunications companies, all 3 of which have been present in income portfolios for decades under business models that generated adequate but not spectacular dividend growth, and all 3 of which are now experiencing cost structure transformations from AI automation deployment that the current valuation multiples have not fully incorporated. The mature industrial manufacturer is the first category, and the specific automation pivot that is changing the income investment case is not robotic assembly, which has been part of industrial manufacturing for 40 years, but AI-driven predictive maintenance and quality control systems that address the cost line items that traditional automation never reached. A large-scale industrial manufacturer running AI-powered predictive maintenance across its equipment fleet reduces unplanned downtime. The most expensive category of manufacturing cost, producing lost production, emergency repair expenditure, and supply chain disruption simultaneously, by identifying failure signatures in operational data before the failure occurs. The cost savings from eliminating unplanned downtime in a large manufacturing facility are not marginal. They can represent 2 to 4 percentage points of operating margin improvement in businesses where the total operating margin was 12 to 15%. Margin expansion of 15 to 30% without any increase in revenue. That margin expansion is not a one-time gain. Predictive maintenance systems improve over time as the AI trains on more operational data, meaning the cost-benefit compounds rather than stabilizing at the initial improvement level. The legacy industrial dividend payer that has deployed this technology at scale in 2025 and 2026 is generating meaningfully more free cash flow per unit of revenue than the same business was generating 2 years ago. And the dividend growth trajectory that the free cash flow supports is correspondingly higher. The established financial service operator is the second category, and the automation pivot here operates on a different cost line, but with equivalent impact on free cash flow generation. Financial service businesses, insurance companies, asset managers, financial data providers have historically carried significant operational cost in the form of labor-intensive processes that were difficult to automate with rule-based systems because they required judgment, pattern recognition, and the processing of unstructured data. Claims processing, underwriting assessment, compliance review, customer service escalation, document analysis, all of these functions are labor-intensive at scale and all of them are being transformed by AI systems that can process unstructured data, apply contextual judgment, and handle volumes that human labor cannot match at any reasonable cost point. An insurance company that has automated 60% of its claims processing workflow has not just reduced labor cost, it has reduced claims cycle time, which reduces the float exposure on outstanding claims, which improves the investment income generated by the float. The automation creates a compounding benefit that touches multiple revenue and cost lines simultaneously. The free cash flow implications for an established financial service operator that has successfully deployed AI automation at meaningful scale in 2026 are not yet fully reflected in analyst models that are still using pre-automation cost assumptions to project forward earnings. The legacy telecommunications company is the third category, and this is the one where the pivot is most counterintuitive because telecommunications companies have been the most frequently cited examples of businesses under structural, competitive, and capital expenditure pressure that makes dividend sustainability difficult to defend. The specific AI automation deployment that is changing the investment case for the best-positioned legacy telecoms is not customer-facing product development. It is network operations optimization. AI systems that manage network traffic routing, fault detection, and capacity allocation in real time at a complexity level that human network operations centers cannot match. The cost of network operations, the labor, the physical operations centers, the fault response infrastructure, is one of the largest operating expense categories for a telecommunications company, and AI-driven network operations optimization is reducing it at rates that are beginning to show in operating cash flow generation for the operators who have deployed it most aggressively. Simultaneously, AI-powered customer service automation is reducing the customer care cost per interaction, one of the other large operating expense categories, by handling a growing percentage of service interactions without human agent involvement. The combined impact on the operating cost structure of a telecommunications company that has deployed both network operations AI and customer service AI at scale is material relative to the narrow free cash flow margins that have historically made telecom dividends among the most debated in the income investor community. The investment case for all three of these categories rests on a specific analytical step that most income investors and most sell-side analysts covering these businesses have not yet taken. The recalculation of the forward free cash flow trajectory using the post-automation cost structure rather than the pre-automation historical run rate, trailing 12-month earnings, historical payout ratios, and 5-year dividend growth rates are all calculated against a cost base that is in the process of being structurally lowered. The forward income potential of the businesses that have made this transition successfully is being measured against a historical benchmark that no longer represents the cost structure those businesses are operating from. The gap between the dividend growth rate implied by the trailing cost structure and the dividend growth rate supported by the post-automation cost structure is the specific opportunity the market has not yet priced in these three categories. Identifying which specific companies within each category have successfully deployed automation at a scale sufficient to produce material free cash flow impact, versus which are still in the early stages of deployment where the investment cost is preceding the benefit year, requires looking at three specific data points that are available in public filings but rarely cited in the headline earnings commentary. The first is the operating expense ratio trend over the past 6 to 8 quarters, specifically whether the ratio of operating expense to revenue is declining and whether the rate of decline has accelerated in the most recent 2 to 3 quarters as automation deployment has scaled. The second is the capital allocation language in recent earnings calls, specifically whether management is discussing automation-driven cost savings as a realized benefit or as a future expectation, because the distinction between a realized benefit and a projected one is the distinction between a dividend growth rate that is already improved and one that is still dependent on successful implementation. The third is the free cash flow coverage ratio trend, not the current level, but the direction and rate of change over the past year, which reveals whether the automation deployment is translating into actual cash generation improvement or whether it is still in the investment phase where the cost of deployment is temporarily compressing the metric it will eventually improve. The legacy dividend payer that passes all three of these tests, declining operating expense ratio, realized rather than projected automation savings in management commentary, and improving free cash flow coverage, OX, is not the same investment it was 2 years ago. The category label has not changed. The financial media coverage has not changed. The valuation multiple the market is applying has not fully changed. But the underlying business has changed, and the dividend growth trajectory that the changed business supports is meaningfully different from the one the historical data would project. That gap between the dividend potential of the post-automation business and the valuation the market is still applying based on the pre-automation cost structure is where the specific income opportunity in this pivot is located. The AI dividend pivot is not a story about technology stocks. It is a story about what happens to the income-generating capacity of mature businesses when a technology that addresses their most stubborn cost structures is finally available and successfully deployed. The boring companies are getting more interesting. The dividend growth rates the market is not expecting are being quietly funded by cost savings the market has not modeled. And the investors who identify the specific names where the post-automation free cash flow trajectory has already diverged from the pre-automation historical baseline are positioned to capture both the income growth and the valuation re-rating that follows when the divergence becomes impossible to ignore.